another real conversation. This is with a guest who is not new to Hedgeye TV, certainly not new to Sound Money. I'd argue that he's one of the OGs of Sound Money, one of the people that actually has had it right for a very long time. Good day to you there, Mr. Hanke, Professor Hanke, I should say.
Yeah, Keith, great to be with you again.
I'd say overwhelming response to a real conversation I had with Judy Shelton. That is the biggest response we've seen in quite some time. This is, she, as you well know, because you're in her book, and she's properly citing you, which you don't always get cited, certainly by the old wall econs or the establishment econs or whoever. That doesn't really matter to me. The topic of Sound Money, how it's linked to the money supply, that's you, right? That's Steve Hanke 101. Why is it that you and Judy Shelton are over here? We might say that you're in the river, using Nate Silver's latest metaphor. There's the village, those that are in the establishment, and then there's us, the rest of us in the river. Why are you and Judy Shelton in the river, and why is Ben Bernanke, Janet Yellen, and everybody else over there and maybe never going to talk?
Well, it's very interesting because the sound money part is really monetarism, and monetarism and the quantity theory of money have been around since at least the 16th century, and that was the establishment until about 30 years ago. And about 30 years ago, we started evolving into kind of a different model, shall we say, a different way of looking at things. And that way of looking at things did not include money. And remember, what is monetarism? In simple terms, without getting into the weeds on the thing, Keith, it's just the changes in the money supply have a significant influence on economic activity and inflation. And in more technical terms, what is economic activity and what is inflation? Well, you know what inflation is. Economic activity is just changes in real GDP. So all that is nominal GDP. Changes in the money supply have a big effect on nominal GDP. And nominal GDP includes two components: the real rate of growth in the economy and inflation. And I've never seen, there's never been a country in history that's had significant inflation. And what I define as significant, meaning 4% or more for over 2 years, that hasn't been preceded by a significant increase in the money supply. So you increase the money supply and inflation goes up. You decrease the money supply and inflation goes down. Now, Keith, I looked at this and published an article in the September 2023 issue of the World Economics Journal. I looked at 147 countries from 1990 to 2021, and I looked at changes in their money supply and changes in their inflation rates. And what was the correlation? The correlation was 0.94. It was almost 1-to-1. I threw out the outliers, 10 countries, knocked it down to 137 countries, and the correlation went up to 0.97. I mean, it's getting pretty darn close to 1. So there's pretty close to a 1-to-1 relationship between changes in the money supply and changes in inflation. And you can see that if you look at current data. You have China, for example. China has a very low inflation rate, 0.4%. Everybody's howling about the low inflation rate in China, or even deflation, they call it. Their inflation target's 3%. They're way below that. But Hanke's golden growth rate, the rate consistent with a 3% inflation in China, is 11%. But where's their money supply? It's only growing at 6.8%. So it's growing, about half the rate that's consistent with hitting a 3% inflation target. And of course, no wonder you have very low inflation. So that's on the low side. Now, if you want to go another country that everybody's looking at recently is Turkey. Mm-hmm. Turkey's money supply is growing at 44%. Their inflation is 49.4%. So high money supply growth, high inflation. Low money supply growth, low inflation. That's basically the story. I mean, it hasn't changed for centuries. The only thing that's changed is that the economic models everybody uses, they don't include money. There's no measure for money in the models. So that's the thing that's been thrown into the rubbish. The economic model has just been thrown away.
Well, I mean that's what to some degree really enrages people, because what you just walked through isn't that isn't that hard to understand if you teach them plainly and simply. You're simplifying the complex, of course, here, but it pisses people off, man. I mean, you got these econs that are running the Fed. Ben Bernanke, comes up with his own rules, on an inflation target, stuff like that. Like what? First of all, the inflation target. Ben Bernanke decides this, in 2012, that it's going to be 2%. I mean, where in the Constitution does it say 2%? Well, and as Shelton likes to ask, why isn't it 0%? What most human beings wouldn't want to have inflation in their cost of living.
Well, it's 2% because inflation. The idea of inflation targeting has been around for a long time, but it actually was formally implemented a couple of decades ago in New Zealand, and the number they used was 2%. So everybody thought, well, that sounds good. We'll do 2%.
Like, are you kidding me? I mean, that's embarrassing, right?
That's where it came from, and the idea was, by the way, in a way, a sound idea. The New Zealanders said, "Oh, we're going to put an inflation target in, and if the governor of the central bank doesn't hit the inflation target over a specified period of time, he's toast." But then they never really have implemented that aspect of the thing. They always have some reason to rationalize why the governor of the central bank and the central bank in New Zealand haven't hit the inflation target. So they've never enforced the pink slip rule, shall we say. If you don't, I think it'd be great, by the way, if actually you put an inflation target in for whatever you want to put in. I agree with Shelton. I'm a zero. I don't want any inflation.
No, I mean, if we were allowed to have just a vote, a U.S. vote on do you or do you not want inflation in your life rising, this would be an overwhelmingly obvious vote. How do we get? I know how we got there, right? We understand why the debt and the deficit is the reason why. We understand why Bernanke wouldn't even talk about the U.S. dollar when setting his monetary policy. I mean, when do you think, and maybe we're about to have that moment, when does the voice of the American people actually trump what a lot of conflict of interest economists have really capitalized on?
Well, the thing is, people, they don't like inflation. There's no question about that. But they don't really understand that the fact that inflation is a tax. It's a tax that no one votes for. I mean, there's no, if you have a direct tax and a tax schedule, the Congress, approves it and so forth. The inflation tax is something no one really improves. It's kind of a stealth tax. And if people got that in their head, they really would be riled up about it. Yeah, I'm actually being taxed by inflation. Yes, you are being taxed because that's how the government finances part of its fiscal deficit. There are two ways to finance a deficit. One is direct taxation, and the other is indirect taxation through an inflation tax. And that's what we've witnessed lately. We've had a big rise in inflation. We went up to a peak in July of 2021 of what? 9.1%. That's a pretty big tax, actually.
Well, I mean, it's
By the way, Keith, you keep mentioning Bernanke, but it was Powell is the one. Powell is the one who actually has openly rejected this quantity theory of money thing. Yeah. Bernanke did not. If you look at the global financial crisis, what happened actually, Bernanke was chairman then. This is 2008. And what happened, of course, Washington came down hard on the banks. They said it was all caused by the banks. Actually, it was caused by Washington because they failed to bail out Lehman and let it go under when Lehman was actually solvent. This was the Secretary of Treasury, Paulson, who didn't care personally for the chairman of Lehman, and he just let the thing go. Mm-hmm. I mean, it's really scandalous because Lehman actually was solvent and should have been bailed out. And if it would have been bailed out, we wouldn't have had the great financial crisis. Anyway, that's water under the bridge. We had the great financial crisis. So what happened? Washington said it was all the bank's fault. They started putting Dodd-Frank came in. Remember that? Yep. And remember Basel III, the capital requirements were increased on the banks. And actually bank lending and banks' contribution to the growth in the money supply, it went negative. It completely collapsed. And what did we have then? Then Bernanke actually did the right thing. Given what was done to the banks and the strangling of banks, the Fed said, we've got to do quantitative easing to inject some juice into the money supply. Otherwise, the money supply is going to completely collapse. And then they did Q2 and Q3. If we wouldn't have had those quantitative easing moves by the Fed at that time, we would have had one heck of a recession because the banks were actually contracting the money supply.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
The reason why I mentioned Bernanke is obviously because he's the one with the 2%, established the 2% target, and everyone's stuck to it since. But I just want to like ring fence this thing. You know, like you said 30 years ago. So, okay, we have Greenspan. And I should quote, actually, I have a good quote from Greenspan that goes in line with what you, almost precisely what you just said about inflation. Deficit spent, this is Alan Greenspan, okay? Deficit spending is simply a scheme for the hidden confiscation of wealth. Gold stands in the way of this insidious process. It stands as the protector of property rights. Okay? That's Alan Greenspan, head of the Federal Reserve, of course, from 1987 to 2006, prior to Bernanke. Then he becomes head of the Fed, and obviously that's not how he speaks. So how did that happen? Like, and again, I don't want to debate whether or not Bernanke did the right thing or not when we're on the edge of chaos, and money supply was the answer. I'm more interested in how the hell did we get stuck with this whole thing, and is it Greenspan not actually doing what got him to be the head of the Federal Reserve, which is actually speak plainly about money like this and inflation, or what happened?
Well, if Greenspan actually did a pretty good job, and if you look at, when I say pretty good job, he did come pretty close to staying on the inflation target of about 2%. It was a little below it actually for some time, and economic growth was good.
Really
during his span of time. And what was going on? Hanke's golden growth rate for the money supply, that a rate consistent with hitting our 2% inflation target, is 6.3%. And that's more or less where Greenspan had it. It was pretty close to 6% most of the time. So I think on the basis of where the inflation target was and the performance of the Fed during his tenure as chairman of the Fed, it was pretty good. He'd get a pretty good grade.
Mm-hmm. But I'm trying to figure out who gets tagged with, trying to pin the tail on the old wall donkey, so to speak. Like it's not, at some point, all of Washington didn't speak like Greenspan, when it comes to the there are over 20,000 of these people that work at the Federal Reserve. This is not a thing. If Judy Shelton was, if they actually confirmed her, that would have been a big thing. Where and why not? Like, if the first of all, let me get your opinion on the election. And if Trump wins, Judy Shelton's absolutely in that picture.
Well, I think if you look at who's going to win the election and look at the betting markets, it looks like Trump now is leading overall and leading in the swing states by pretty big margins. But the interesting thing about the poly markets, for example, which is the biggest betting market, the momentum. A month ago, he was down. Mm-hmm. A month and a half ago, he was down vis-a-vis Harris, and now he's really shot up in the last couple of weeks. So that's what the markets are saying, and even the polls are kind of catching up with that a little bit. I like the markets because the markets it's like the stock market. If you look at the stock market, you can look at it as in a subjective way, and if you look at subjective way, that's all the analysts. Everybody has their way of analyzing and valuing a stock. So you get thousands of analysts out there. Those are subjective numbers, but once those are brought into the market, sucked into the market with people that are actually putting skin in the game and buying and selling stocks, you get what? You get a market price in the stock market, and that's objective. You can't argue. The price is the price, and that's it. If you accumulate all buyers and sellers who are willing to put skin in the game, and you come up with a price, and it's an objective price, and that's what happens in these betting markets. And so those numbers are objective. Now the polling is subjective. That's like the analyst, because that's somebody calling you on the telephone, asking you how you're going to vote. Well, maybe you're going to vote for Trump, but maybe you don't think the person who's telephoned you from the polling service wants to hear that, or you'd be embarrassed to say that. Mm-hmm. So you say, well, I'm not going to vote, or I'm going to vote for Harris. So there are many ways they try to get the biases out of polling, but it's still hard to do. And polling is less accurate and more subjective than the betting markets. Mm-hmm. So that's where we're at. Who's going to win, and what Trump would do relative to nominations for the Fed. Whose guess? I mean, no one's betting on that, so I don't know what the odds are.
Well, I want. That's what I'm proposing. That's what I want. I mean, I have interviewed Vivek Ramaswamy on this topic, and he says the same thing. He's like, we don't need 20,000 people at the Fed. We need a rules-based system that involves like modern day math, probably Hanke's rules. I don't know if you just politically you have to blend in some other Taylor rule or whatever, but what you have now, according to young Republicans that are leading the party, they would side, and I'm not a Republican, I'm not a Democrat, I'm Canadian, but on this topic, I would absolutely side with them and you and Shelton on money, and starting with money, and money is a moral contract, as Judy would say. that to me is a much better place to get to. And I don't know who else you would have lead that charge that would want to work at the Federal Reserve other than Judy Shelton. I don't think you want to work at the Fed, do you?
No.
No, it's like, yeah, I don't either. People are like, what would you do at the Fed? I go, I would rather eat a steady diet of yellow snow than to work at the Federal Reserve. No, I don't believe in central planning. I don't think that that's a thing, like central market planning. But is that, could you envision that? Any kind of a shift at the Federal Reserve that has actually got teeth to it?
Well, realistically, you've got the research economist. Of course, you have a lot of people working at the Fed. You gave a big number. There, as I recall off the top of my head, there around 700 economists that work at the Fed in the whole system, not just in Washington. But the problem is that the big majority of them actually are Democrats. Mm-hmm. I can't remember exactly the ratio. It's quite large, and there's a nice article that goes through all this in the Independent Review of a couple of years ago. But so you have a heavily weighted, large economic research staff that happens to be Democrat. Now that has something to do with the way they look at the world, because remember, who is enemy number one in the economic sphere of people who are Democrats? Well, it happens to be Milton Friedman. And Milton Friedman was a quantity theory of money man. He was like me, a monetarist. And you, therefore, don't find the monetarist model, a quantity theory of money at the Fed, I think, for political reasons. That's one aspect of it. That's a factor. The other factor is this thing I was talking about. For 30 years, we've had graduate students who have been taught post-Keynesian economics, and those macroeconomic models that they use, they don't include money. They don't look at the quantity theory of money.
Not even close.
How in the world can you be running a central bank that its main responsibility is the money supply, and they don't have money in the models that they use to analyze the situation? And Powell, by the way, Powell has said in testimony repeatedly over and over, we don't follow the money supply. We don't look at the money supply because there's an unreliable linkage between changes in the money supply and changes in the economy, which I just started by saying that's not true. That when we opened our conversation, I gave you even my study of the 147 countries where you have a 0.94 correlation between changes in the money supply and changes in inflation, from looking at data from 1990 to 2021. So it's as plain as the nose on your face that there's a connection between the money supply and changes in inflation, changes in economic activity, changes in asset prices. Why did the stock market go up so heavily after we had the COVID pandemic come in, and we had the money supply shoot up? It was growing at 17% year over year. That's an all-time high since 1913.
Yeah,
and by the way, Keith, that's a lot higher than Hanke's golden growth rate of 6%. That's consistent with the 2%.
Yeah, I'd say so. And for those of you that don't know Steve, I mean, he nailed it. He's the only economist that said inflation was going to go to 9%, and it did. Okay, so look at this chart. Steve knows this. This is basically should be his chart, his crown jewel chart. Slide 107, guys, just to show people the money supply. And I'm using M2 here, Steve. Please don't criticize me for it or anything like that. But the real thing I want to show is the rate of change that Steve just called out. So if you go to 2020, you see how the line was upward sloping and didn't have like a lot of pop? I mean, then all of a sudden it just ripped, right? So that, to sit there and say that you're not accountable for that. It's just supply shortages, the inflation problem we have. We can't quite put our finger on it. It's bullshit, right? Powell's full of shit. I mean, that's
there is a lot of bull dust in the picture, Keith, and it's repeated in the press. This is what confuses people. Here's the fundamental problem in simple terms. People have been brainwashed to become data dependent, like the Fed. Now, what does that mean? That means they look at every piece of economic data that comes out, day by day, week by week, month by month, and basically they don't have a model. They just look at the numbers. They don't have a model. They have the finger in the wind, and if all of a sudden inflation goes up, boom, what happens? The bond prices go down, the yields go up, stock market goes down. You get a market reaction, and then it settles down until the next piece of data come out. But what you have to do with quantity theory of money, you look at the money supply, because that's what drives everything. And then there's a transmission mechanism, Keith. You get a change in the money supply that's significant, and then about 1 to 9 months later, you get changes in asset prices, changes in the stock market, changes in real estate values. And then in stage 2, after about 6 to 18 months after the change in the money supply has occurred, you get changes in economic activity. That's real GDP. And then with a lag of about 12 to 24 months, you get changes in inflation, finally. So it's all laid out, and that's exactly what happened when we had the big goose in the money supply after the pandemic hit in February of 2020. The money supply goes up, and by the time you get to February 2021, it's 17% year over year, and that's almost 3 times higher than Hanke's golden growth rate of 6%. Alan Greenspan never did that, and neither did Bernanke, by the way. Bernanke had Q1, Q2, Q3, and a lot of people said, oh, the balance sheet of the Fed is exploding. We're going to have hyperinflation, huge inflation. It was utter rubbish, because the big engine that produces money in the United States is the commercial banking system. And the commercial banking system was negative or flat. It wasn't contributing anything, because you had all these regulations coming from Dodd-Frank out of Washington, D.C. And then from Basel, Switzerland, we also had another thing coming, and that was Basel III, that required the banks to increase their capital asset ratios. So no one understands the great financial crisis, and the reason they don't understand it is they don't understand the quantity theory of money, because the money supply did not change that much at all. In fact, it was the reason our growth rate was so slow coming out of the great financial crisis was the fact that the money supply was actually growing at less than Hanke's golden growth rate of 6%. It stayed very low for a long time, and inflation stayed very low for a long time.
Yeah, that you can see that on that chart. I mean, it didn't really move. There's no hockey sticking in at the 2008. We show that shaded area.
One thing, Keith, we talk about the Fed all the time, but let me just emphasize again that the big point in M2, you've got M2 up there, which is the broadest measure of money that they use in the United States, and that M2 is made up about 75% of the total amount of M2. It's produced by commercial banks,
right?
Not by the Fed.
Mm-hmm. If you could, you just, because you just touched on it, but give us the breakdown, how you think of, of course they're going to regulate the banks and do Basel times 10 or try, but nobody would ever regulate the Feds, or not the Fed, the federal government's, I should say, debt and deficits, right? I mean, like, how do you contextualize this thing, this monster that it's tough to not see it, right?
Well, yeah, the deficit, of course, ends up piling up the total amount of debt. So you have an annual deficit that's like something on an income statement of flow, but the balance sheet part of the thing, the stock of debt, is being built up incrementally by this annual deficit. And we've tried in the United States various statutory moves to control that. They're kind of like band-aids. They work for a couple of years and then they tear off and don't work. What you have to do is go to Article 5 of the U.S. Constitution and have a constitutional convention, a convention of states, actually, convention of states, in which they focus on changing the U.S. Constitution and putting in something like a Swiss debt brake, where the Swiss debt brake, by the way, that was put in after a referenda in 2001 in Switzerland, says that the Swiss have to balance their budget and they can't allow government spending to grow faster than the forecast in real GDP. So the government's constrained. Number one, that rule that the government spending can't grow any faster than the economy means that the government won't expand and squeeze out the private sector. So that's one constraint. The second constraint in the Swiss debt brake is that they must balance the budget over the intermediate term, and they can have a little surplus or a little deficit, but they have to get it back in balance over intermediate over 2 or 3 years. So that's the kind of approach that will solve the problem, but that's the only way to do it. The elected politicians are not going to do it themselves, and they have tried, by the way, some of these statutory band-aid kind of fixes that temporarily work but never are permanent.
Yeah, I mean, when we look at this, you wrote some really good notes on how quickly, the debt is actually going up. Can you talk about that?
Well, the debt in the United States is going up very rapidly, and even the Congressional Budget Office, which is a nonpartisan governmental think tank, if you will, they have indicated this isn't sustainable. It can't continue. We can't continue to be piling up debt like this.
Well, everyone says that, but it keeps piling up like daily.
It keeps piling up. So the question is, how do you stop it? And if something can't continue, it will stop.
Right.
And the question is how. There are only really 3 ways to do it. One is to increase direct taxes. 2 is to increase the inflation tax. And 3 is to have a convention of states under Article 5 of the U.S. Constitution and change the U.S. Constitution so you put a rule in the Constitution that controls this. That's the only way to do it.
Yeah, it'd have to be rules.
I mean, you have 3 ways to do it, actually. My preferred way is to go to a convention of states, Article 5 of the Constitution, put it in the Constitution, constrain the growth in government to the growth rate in real GDP, and require a balanced budget over an intermediate period of time, 2 or 3 years.
It has
to be balanced.
That's going to mean you're going to have to take the pain, but you get the long-term gain, so to speak. In your notes,
the reason, by the way, that this thing isn't sustainable is that the interest cost on the debt, the interest cost now is soaring. The interest cost is actually greater than the budget for the Defense Department in the United States right now. Now, what do people get? What do taxpayers get for this interest charge? They get nothing. They're just paying off creditors who loaned money to the government so the government could spend money a year ago or 2 years ago or 3 years ago, whatever.
Yeah, the guys, if you show slide 128, you can see what Steve just said. He's obviously an encyclopedia, but when you think about look at that. Can you see that chart, Steve? I know
Yes,
you know
I
it, right? I mean, so people would say like forever and a day. Well, interest expense is not a big deal because it's been there all along and it's not really going up much. Well, that's until now, right? To your point, this thing isn't just going above defense spending; it is going epic hockey stick above defense spending. So
absolutely. So it doesn't take a genius at the Congressional Budget Office to figure out that. Well, I mean, pretty soon, virtually all of the taxes that are being paid are going to be going to pay interest, and squeezing out everything in the budget. I mean, we'll just be paying interest.
The math just doesn't work. I mean, and at a point, now people are really starting to have their panic attacks again on the long end of the yield curve because they see the inflation reaccelerating and they see the deficits not stopping. I mean, in your notes, you said debt has swelled by $473 billion in the last 3 weeks. That's costing Americans a startling $15.6 million per minute.
Yeah, we're talking about real numbers here.
Holy hell. I mean, that's the thing. So you got both parties are responsible for it, right? You don't have anyone that appears to have a policy. The pending president doesn't have a policy to stop it. So does the bond market have to stop it? Gold looks like it's the way out of it, by the way. That's been a home run for us.
Well, yeah, I think the last time we were on, I said gold was going to go up, and it has gone up, as you have indicated. I mean, we've hit new all-time highs just this week, actually.
Yep.
So and that's one reason for the gold going up. But I think there are other reasons, and if you look at particularly the stock market, there are actually 4 risks that people are kind of completely ignoring. One is the valuations in the market are very high, very pricey. So there's a risk that you got a little bubble action in there, and maybe the bubble will pop. So that's a risk no one seems to be paying any attention to. The second thing, you've got these 2 big wars going that the U.S. is financing. The war in Ukraine is being largely financed by the United States. The Israeli military operations are largely financed by the United States. So the United States is funding a lot of wars, and the war risk that things get out of control is I don't think being priced into the market much for anything except maybe gold. Mm-hmm. Now, the third thing is that the green transition costs have been completely ignored and underestimated. If you're going to mandate that you're going green, it's going to cost an arm and a leg. There's no such thing as a green free lunch, and we're starting to learn that a little bit. Yeah. But it's not really priced into anything or the budget. And then the last thing is the recession. And I think if you look at the quantity theory of money, getting back to where we started, Keith, we've had the money supply contract since July of 2022. That means the stock of money now is lower than it was in July of 2022. That kind of contraction's only happened 4 times since the Fed was established in 1913, and each one of those led to a recession. And this contraction will also lead to a recession. And that's not priced into the market at all. All these data-dependent people are saying soft landing, soft landing, soft landing. Well, they're gonna get the surprise of their life when the change in the money supply that occurred a couple years ago comes with that lag through the system and hits like a time bomb.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
Yeah, many small businesses, if not most, would tell you they're already in one, and sadly, what 2/3 of Americans couldn't come up with $500 by the end of the week if they tried. There is a depression in parts of the U.S. economy. It's just not the people that work on Wall Street. It's not the people that work in the village, in academia, in the media, like all the bullshit. They're getting paid, right? And the people are having to. They're going to have to.
How about the main surge in employment we've had in the Biden years? Government employees. You look at the employment report if you want to be data dependent now, and look at the employment reports when they come out. Every one of those things has had a huge chunk of the increase in government employment.
Big time.
And the other component is in the private sector, services that have also, but those have been the two big things. And what do you get with government employment? I mean, it's just a black hole. I mean, what are they contributing?
Yeah, it's what it is. I mean, I don't think one can say that a third of hires in 2023, which were funded by government deficit spending, wasn't political. I mean, it's very clear. And like you said, that crowds out the private sector because the private sector has to compete with those wages. So you're screwed. That's why the small business owner is screwed. And it's a man-made thing. That's the problem. We need to wrap up here, but I two last questions for you. One, let's. You have a book coming out. Do you want to? Can you give us? We'll show you guys a quick snapshot of Steve's new book. What I love is that the two OGs, you and Judy Shelton, have two new books, right? And it's a perfect time to have a new book. And the title there is Capital, Interest, and Waiting. Why now?
Well, why now? Because I happen to have been working on this with Leland Yeager for more or less 25 years. And we finally finished it.
Nice.
So you can get that, by the way. I just received my hard copy. You can buy an ebook or hard copy from Paul Greg Macmillan, and what there's a lot of economic theory in the book, but there are a lot of practical aspects that relate to the financial markets. We even have a chapter on the yield curve in there, and another chapter on monetary policy. But the main thing is this. The really big thing is this, and that is if you look at any basic economic books, you'll find that what are the inputs to the economic system in all the models where you have land, labor, and capital. That's true, land, labor, and capital. We have another one that we've just articulated and fleshed out, and that's waiting. Now, what is waiting? Waiting is not consuming and allowing those funds that you have received that you have not used up in consumption to be placed in the market. And what is the price for waiting? It's the interest rate. Mm-hmm. So we have now land, labor, capital, and waiting, and we work through how waiting works into the system, how it contributes to economic growth and prosperity, and the fact that waiting, like land, rent is the price for land, labor, wages, capital is interest, and waiting is interest.
Yep.
So at any rate, I think people will find it a great read, and particularly the people who are studying economics.
Well, I mean, you're going to make fun of me, so have at it. I have a BA in economics from Yale. Now, that will teach you what not to do in the markets, okay? And sadly, many people have been educated that way. And fortunately, I used some common sense and actually know some things about money. So it got me to where I'm at today. But my hope is that books like this, books like Shelton's, and they're the foundation of the future, right? Like as my partner Neil Howe, who wrote a book called The Fourth Turning, is saying, this is really a generational problem. Like you just got to get rid of the establishment, their media, the elites, and all their dogma and bullshit when it comes to traditional economics or Keynes, like you said, what I was taught. That's a real, that provides optimism, Steve. Like I like that. The idea that, and maybe to finish on this, I don't know if Judy has spoken to you about it or not, or if you read her book, but she has a tangible idea with these.
Actually, I did a book blurb for her book and endorsed it.
Right. Yeah. And she compliments Steve in the book. She loves Steve, and everybody should love Steve. And this is a huge contribution that you guys are making with these books at this stage of your career. But she presents the idea. One of the solutions are these TTBs, or Treasury Trust Bonds, that are backed by gold. Right. Have you thought about that? Do you care about that? Do you think it's a good idea?
Yeah, I do. She's worked this out. I think it is something that definitely should be given very serious consideration, and that's why it would have been a good idea to have her on the Fed board. Maybe there would have been a conversation about this.
Yeah.
Not now. After many years of working on it, she's articulated it in a clear way in this new book of hers, which is great. And remember, one of our mentors, both Shelton and myself, it was Robert Mundell, Nobel laureate in economics. And as Mundell always put it, gold will always remain somehow in the international financial system. And I think this proposal that she has is one way to make certain that it stays in there. By the way, it's clearly front and center right now as gold's making new highs, for all the reasons that I gave you. There are a lot of risk out there, and when there are a lot of risk out there, people want solid money.
Yeah, I mean, I embarrassed myself with the Yale econ degree thing, but I am, like Mundell, a Canadian. So that's one thing I have going for me, Steve. That's a great call out, because not a lot of people talk about Mundell, but he was one of the most influential economists of all time. I mean, why would you talk about him or Milton Friedman?
No question about it. I mean, he's not only one of the fathers of supply side economics, but also the father of the euro. Yep. So, the guy's the real deal.
He is, and so is Steve Hanke. So unfortunately, we're out of time. I could talk to you all day, but thanks for making time to have a real conversation with me again. And I'll make sure I'm going to get your book. And what I like to do is read the book, study the book, reread the book, and cite it in what we call the early look, which, again, I flog Wall Street with this thing, so they're not going to be able to run away from sound money, because now I got two weapons. I got the Shelton book, I got the Hanke book, and I'm just going to keep quoting you guys. So thank you for the content.
Let's nudge these post-Keynesian models out of the picture.
Yeah. See how polite you can say it? Like I get a little bit more aggressive about this, and I think you should. I think there's passion, that you have to have if you have new ideas, and you certainly have to have passion when you're considering replacing broken ideas. So again, sound money. I don't know one human being, unless they're wholly conflict of interest, and getting paid by fiat, and they need that. Every single person I know, whether they're in this profession or anywhere in this world, understands the value of a dollar, okay? And we need to preserve and protect that, all right? So thank you very much for, again, joining us, and we'll see you next time.